So now you've seen the essence of how to estimate cost of equity and cost of debt for a company. So what you should have already seen is how the CAPM works. So the CAPM, for our purposes, is a tool for estimating the cost of equity finance for a company, where the cost goes up the higher the beta of the firm is. So you should know how what the CAPM is, how in principle it's estimated, what elements you need to create it. We also should know what the beta actually means in terms of what it means for the company, and how it keeps to how the firm operates in practice. Then you should know the cost of debt. Now, for our purposes, we're going to just stick to using the cost of borrowing as the cost of debt. So the cost of debt is a relatively simple calculation compared to the cost of equity, which is sort of difficult because it's sort of unknown without using a model like the CAPM. With the cost of debt and the cost of equity, you can then think about how a firm chooses between those two. And you can also think about how a firm can be compared to other firms in its industry. So very often comparables are a very useful way of trying to think about the cost of finance for your firm, even if you don't have that much historical evidence to go on. You can see how betas can be estimated both using historical data, comparable data, and other sources. And also, so you can see how leverage is going to influence the CAPM and the beta of your firm. So in a sense, that issue of leverage is one we're going to come back to over and over again. So give yourself a chance to think about that issue. And then just generally, you should understand how the CAPM works, how it's a model that is very widely used, has a number of problems in practice, but it is still the workhorse model for thinking about how to value your company and how to think about the cost of equity finance. Okay, so the CAPM itself. So this is something that you've read about. So CAPM stands for Capital Asset Pricing Model, and it has a very, once you've got the idea of it, a very sort of simple background to it. It says, if your company was risk-free, you could borrow at something called the risk-free rate, which for practical purposes usually means the rate at which the government can borrow at, or the rate at which a very safe bank could borrow at, let's say. So you've got your risk-free rate, but since you're a company, and we're talking about shares here, we're talking about the price of your shares, the shares will vary in value from day to day. So they'll go up and down in price depending on how your company is doing. And that up and downness in price, so we're not talking about default here, we're just talking about volatility, the fact that your share price goes up and down, makes your company potentially less attractive. Investors don't want very volatile returns on their investments. They like safe, renewable returns, that risk-free rate I mentioned at the beginning. So the more volatile your share price is, the less investors will like your company, the higher your cost of equity, the more you'll have to give them when you want to issue equity. So the key wrinkle of the capital asset pricing model, though, is that volatility is not just how much your price goes up or down, it's how much your price goes up and down with the rest of the market. So there's a real intuitive point, which I say you'll see in other modules, and hopefully you've got already, which is volatility in itself is not a problem for investors because they can hold a diversified portfolio. So let's say I have a company that has very volatile share price. Investors will still buy my company because I'll say, well, if I only buy a small amount of his company compared to the size of my portfolio, it won't affect my whole portfolio. It'll just be some idiosyncratic volatility that hardly affects my total returns. However, if it's the case that the volatility of my company is correlated or moves along with all the other shares I have in my portfolio, then I'm not going to like your company because now I've got 100 shares in my portfolio. They all go up on the same day. They all go down on the same day. And therefore the beta is a measure of what is called systematic volatility. It's a measure of how not only how volatile your share price is, but how much it goes up and down with the rest of the market. Because that's the thing that you can't diversify away as an investor. That's the thing that people don't like. So as you can see on the slide, the CAPM boils down into a simple formula. It says the rate of return on a given, let's say equity, so the RI, is equal to the risk-free rate plus your beta times the difference between the market rate of return and the risk-free rate. So the rate of return on the, let's say, the stock market index and the risk-free rate If you have a beta of 1, it means your share price moves exactly in line with the index, with the rest of the market. So your rate of return should be equal to that of the market. If your beta is more than 1, it means when the market goes up 1%, on average you go up 2% or some higher number. If it goes down 1%, you go down more than 1%. So you're particularly unattractive because you actually are a risky bet on the market. If your beta is less than 1, it means you don't move along with the market as much. So you can offer a lower rate of return than the market rate of return. So basically where you stand relative to the risk-free rate and the market rate depends on your beta. Beta of 0, you can borrow at the risk-free rate or you can issue equity at the risk-free rate. Beta of 1, you issue at the market rate, the rate on the stock market index. Betas in between, you get a differential rate of return. Betas above, you get a higher rate of return. So that's really what the CAPM does. And as I said, for our purposes, what we're using it for is to think about, if I was sitting in a company thinking about doing an IPO or a seasoned equity offering, what effectively would I have to pay shareholders to hold my shares? The beta is a way of estimating that. If I'm a high beta company, I'm going to have to pay shareholders quite a lot to get them to hold my shares. If I'm a low beta company, a lot less. So the CAPM is a tool for estimating your cost of equity finance, and it depends on your characteristics as a firm on your beta. So as I say, that's quite a tricky concept you haven't done in other modules, but hopefully with a bit of thinking about it, you'll get there. And as I say, and the key for us is beta is a measure of risk of the corporation. Okay, so now how do you use it in practice? Well, clearly you need a risk-free rate, which, as I mentioned, is usually the rate on government securities. You need a historical risk premium, or the difference between the rate of return on the market and the rate of return on the risk-free rate. And that usually, you just estimate that using historical data. And historically, that's been in the range of about 4 to 6%. So if the risk-free rate is 4%, you would expect the rate on an equity investment in the stock market index to deliver 8% or more. So because that's the premium that you expect for investing in a risky investment like the stock market compared to sticking it in the risk-free rate. So with those two numbers, you've got the risk-free rate, you've got the market rate of return. Now where your company lies depends on what your beta is. And your beta can be estimated in a bunch of different ways. For the statisticians amongst you, it can be estimated using regression analysis. You just simply look at how your firm historically has performed relative to the rest of the market. For those of you less keen on that, you can use comparables, or in fact, quite often there are ways of just getting a beta for your industry or parts of your industry. So those are the three things you need to estimate your cost of equity. Cost of debt, if you have debt, is nice and simple. It's how much are you paying on your debt. So obviously there's issues of maturity of the debt, etc. But generally speaking, usually the cost of debt is taken as the cost of your long-term debt as a company. So how much are you borrowing for, let's say, for a year or more. So what's the rate of interest you're paying on that? So we've got the cost of your debt finance, which is how much you're actually paying on debts you have, or perhaps what comparable firms are paying. And we've got the cost of equity finance, which we're estimating at this stage through the CAPM. So now you can see how much it's going to cost you to raise money through the equity market, how much through the debt market. And so what we can now introduce now is it's a tool that we're going to use a lot through the next few chapters, is the issue of the cost of capital. So if you think back to what we did, particularly in lectures 1 and 2, we were thinking about discounting future cash flows, about valuing projects. And I was always talking about the discount rate, the rate of return that you're going to use to discount those future cash flows. We now have that discount rate. For a given firm, the rate to which you discount future cash flows is what's called your weighted average cost of capital, your WACC. That's to say, it's going to be a mixture of your debt cost of finance and your equity cost of finance, where that mix is determined by how much you use debt and equity. So your cost of capital for a firm is basically how much it's going to cost you to issue the equity and finance. So as you can see on the slide, your overall cost of finance is the share of equity in your finance times the cost of equity finance, plus the share of debt in your finance times the cost of debt finance. So it's just a weighted average of those two things. And that is going to be a key tool for you as a company, because that's the discount rate you're going to use to value projects, use to value the firm, etc. So it's a fundamental number for thinking about your company. And of course, what we're going to use it for the next few topics is to think about, is there a way of fiddling the share of debt and equity to achieve a better cost of capital? If you can lower your cost of capital as a firm, whole new projects become viable, your company is actually worth more in the market. So just trying to get that cost of capital down is actually a key objective, and we're going to see if there are any tricks that you can follow to try and get you to do that. But at the beginning, we're going to show you a very simple idea, which is it's very hard to change your cost of capital as a firm, and we're going to see why. But before that, we're going to do that first, then move on to some possible nuances. But at this point, we just need to know that the cost of capital for equity can be determined by the CAPM, the cost of debt, by your cost of borrowing, the weighted average cost of capital, combination of the two. And then we'll move on to thinking about how to weight this together, and in particular that little 1 minus tau term, the tax effects, as we move through the capital structure topics.